let's talk about something very interesting, because the discourse about the declining value of the Nigerian currency is an ongoing one, with so much energy dispensed on whether to devalue or free flow to the local unit. But what would it take Nigeria to make the Naira stronger or competitive against other international units? Digging into this conversation with me, with some historical perspectives, really, we need that this evening, is a development economist. Professor Kenneth Ife is joining us from our Abuja studios. Good evening to you, Professor. Welcome, and it's good to have you again on the show tonight. We appreciate your time.
Thank you for inviting me.
Thank you, sir. My first question to you, what are the requirements or requisites for a strong currency of any country, anywhere in the world, whether it is the United States or China or Liberia, whatever? What does it require to have a strong currency?
Well, you need to have a big source of foreign exchange into your country, which is usually coming by way of export. And I'm glad you actually mentioned Ghana's experience, because Nigeria is now buying the gold with Naira and then helping to send them up for refining and bring them back and build our gold reserves. So that is a very strong way of beginning to move on the agenda you are discussing. So we want to see more of that happen in Nigeria, of course. Well, you need to have very strong reserves, of course. That is what guarantees your export according to ECOWAS convergence criteria, says at least 3 months, and Nigeria can actually boast of 6 to 9 months, so that's helpful. But also you need to diversify the source of that Forex revenue, or even Forex income, even if it is not. Of course, the oil and gas are our traditional source. But we do have agriculture that needs to be beefed up through value addition, and we have foreign direct investment that comes in. That's been neither here nor there, and is dwindled to less than $1 billion. And then we have foreign portfolio investment, which capitalizes on high interest rates. But more than high interest rates, they come in when there is transparency and effective monetary policy management and stable Forex policy, because it's not whether your Naira is too strong or too weak. Either way can still cause problem for the economy, but maintaining it at a stable rate, predictable, is very, very important to investors bringing in their money. Because if it is unstable, it means that it increases speculation. And if it is at the backdrop, and there's a backdrop of also inflation that is also in the picture, because...
Professor Ife, sorry, very quickly, so is it about the numbers? So is it whether the Naira is 1 Naira to the dollar that really matters, or is 100 Naira to the dollar? Does that really matter? Is it a function of the figures that we've got in our heads?
No, what matters, in my view, what matters more is not whether Naira is the strongest at 1 Naira to $1 or weakest at 1,000 Naira to $1. Is where it finds its level, then you should be able to maintain a stable currency. That is, stability is key. Because the reason why stability is key, people who want to invest in that economy wants to be predictable. They want to see transparency in the management of that Forex regime, and they want it to be steady so that they can anticipate that if their money enters today, speculation and all the things that make that create pressure on Naira will not play in such a way that within a year, the high inflation and all other speculatory activity will dramatically drop the value of that currency.
So what should we be chasing? Stable currency, stable Naira, or a strong Naira? Or both?
Well, there are weaknesses and strengths in a strong Naira. If the Naira is very strong, it hurts the country, because it means that you are not competitive. Your products are going to be too expensive. And then we don't even have the products. All we have is oil and gas. We don't determine the price. We don't determine the production volume. Somebody else determines it for us. But if we have products, other products that we directly export, and we have control over their prices, then the competitiveness of our prices will be open to question. In the same way, if it falls too high, then import becomes very expensive. when the currency low is very, very low, the import is very, very expensive. And once they're expensive, bearing in mind that 80% of our industries are importing their raw materials and spare parts and something to do with export. So that would affect prices in the country, because once you have a high cost of imports because of your very low currency strength, then it's going to transmit and pass through to inflation, to the consumers. You have an inflation pass through, and that hurts the economy as well.
Again, so is devaluation or free floating the currency the only requirement for a country to achieve a strong local unit?
No, you see, from the time of the Bretton Woods institutions and the gold standard of 1944, which eventually collapsed around 1971 when America dropped the standard, the gold standard, and then we now went into currency, floating of currencies, and then eventually basket of currencies and all of that. The lessons are that floating it is not a panacea. You still have to have a measure of intervention from the central bank, because even if it is floating, it still has to be tuning it and then intervening gradually. Look at what happened to UK in 1991. Before what happened, we entered into the European monetary mechanism, and then we got attacked. The pound got attacked, and we lost $3.3 billion. And then overnight, and then we had to run out. We have to come out of the European exchange mechanism, the euro, which gave rise to the euro. So you still have to be there to defend that currency. So in a way, it helps. But in the case of Nigeria, where you know that the real issue is the level of income we are getting from Forex cannot meet the demand for that Forex. So that fundamental mismatch means that there must be a measure of intervention. Now, also in our own case, we've tried to get 93% of the Forex regime under control by the central bank. And then that 93%, you have the NAFEX window, the IEO windows, you've got them fairly stable with GBN constantly intervening when there is a need. And then you have the 7%, the black market 7% that perturbs the whole system and is driven by speculation and all kinds of structural factors. You have the security issue playing the highest, and then you have people who just want to monetize and dollarize the economy, people who want to hold dollar, all kinds of situations there, very, very, so many. And then that is, creating more anxiety, because there's so much speculation going on in that 7% of our Forex economy, that's the black market, that, it is shaking the confidence of the people.
Now, when we return, Professor Ken, we'll try to go back. I want you to go historically for us. Folks say, well, there was a time when the Naira was stronger than the pound and the dollar. How did we achieve that then? What are we missing right now? And can we walk our way back to those, what they call the glorious days of the Naira? There's more after this, after the break. Stand by, everyone. We're right back. Welcome back to the conversation on how to reinflate and reposition the Naira. My guest in our Abuja studios, Professor Ken Ife, a development economist. Thank you very much, Prof, for standing by. My point, my next question is just going to break about Nigeria's brief history of a strong Naira. I think that should be around the mid-70s to the mid-80s. How was that achieved?
Well, first of all, we were having a net inflow of Forex. The oil was giving us much more money, and we were having to export less than what we were getting in. So we have positive balance of payment and balance of trade. Then we also had the government proactively investing in industry. So we had like the import substitution. We had the importation of cars were restricted because we are assembling Volkswagen somewhere, and then Peugeot in Kaduna, and then we have Anamco doing truck. So, and then tires were being made by Odetola and the rest of them, spare parts. So we're actually substituting the import, not now when we are importing over 600,000 cars. And 400,000 of them are coming in from Cotonou, and 200,000 a year from Loro Port. Then we also have iron and steel going in there, much investment. And the tragedy is that all of this investment at the time should have been, maybe after 5 years, you should have actually turned them in as PLC, so that the people, everybody gets involved in it, and private capital will come in, and management will come in as well. So what happened is that we are doing better on the export than an import, and effectively substitute some of even to the point that we had import substitution agenda on beer. So we had the sorghum, sweet sorghum, being used to dilute the belly. You have cassava incorporated in bread. So some of these agendas, we are paying dividends, and we are seeing our employment. In the textile industry, over 2 million people were being employed in the textile industry, in all these factories in Kano and Kaduna and down. So they were all big industries employing a lot of people. But the moment we came into this whole structural adjustment program, the liberalization scheme, and we're no longer talking about protecting our infant industries, we threw everything to the wind. And then you have cheap imports invade the country. And that forced all these companies to close down. And as soon as you're doing that, you are not handing over these companies to private sector to fight it out. You just still continued with the poor management structure of federal government-run businesses. And that was how they gone. They all went, and jobs were irreplaceable. The industrial structure was traumatized, and that's where we haven't recovered from that. Up until now, we haven't recovered from that. But on the other hand, we are doing well in services. The services have now grown to 54%, to 56% of our GDP. But we still need, while the services are doing well in the country, they're not earning us the foreign exchange. So we still need to go back to industry, because it's the industry that will give us the foreign exchange. We are selling the crude, but we should be producing and exporting the downstream and midstream products, derivatives of oil and gas, exporting those, ethylene and polyethylene and all of those products. Then also at the same time, solid minerals should be exported to bring revenue. And I'm glad that we could be doing something on gold, but we should do more. And then even the agricultural products should move from commodity base to value addition, progressive value addition, not only to substitute the import, but also to be exportable. South Africa is doing well on export, and the same as Kenya and Tanzania, and even Ghana and Cote d'Ivoire. They're doing much, much better than we're doing in relative terms. But having said that, there are other capacities that are to be utilized to actually ensure that we increase the flow. For example, if over 88% of the foreign trade involves maritime. And so what are we doing about empty ships going back after bringing over 1 million metric containers a day? They are going back. And when they go back, they cost you almost double, 50% to 100% more for shipping, because it's going back. Your backhaul capacity is not there. Then also the aircrafts coming in like DHL and some of those that are going empty. And because they are going empty, you don't have the backhaul capacity, they charge you more to bring them in. So we need to visit. You heard what the president of the ADB said, Akinwumi, that for shipping 100 metric tons of goods cost Ghana about $4,000 and cost Nigeria $35,000. That's what it costs. And look at that difference. It doesn't show us to be serious about utilizing our backhaul capacity to export and get more foreign revenue.
Now, well said, Professor. We'll talk about the dollarization of the economy. The central bank talk about it sometimes as well. The question is, how do we get the dollar out of the Nigeria's mindset and replace it with the naira? Yeah, the naira is what everybody spends every day. You go to a store, you go to a restaurant, whatever. But in our mindset, at the back of our brain, is the dollar that we see. So I'm just thinking, can we get those days back in which Nigerians are proud of the currency? They want to hold the naira as the currency of their country.
Well, the fundamental mismatch has to be addressed, that we are earning less than we are wanting to spend. And so there has to be a measure of currency demand management. And that's what has been done effectively in 2017 by CBN are bringing down the 43 items under. But he didn't ban them. He just says, I haven't got the currency to give you. He didn't ban them. So they are still going to the black market to get currency to import those goods. There's more to do on those, but that's from the fiscal side. Then the other thing, of course, is that we have to exploit the capacity that we have to earn more. To think that you can change the world and expect that FDI will come in is just wishful thinking, because it's not going to come. There are structural factors that are preventing those FDIs from coming. The primary one is security. Security is also what is affecting agriculture, and agriculture is what is fueling inflation, apart from other things. And then, of course, all of them have knock-on effect on investment, because if you are investing and there's a low interest regime, we need a higher interest rate regime to bring in the portfolio investment. And if you don't have that, they are going to be looking at what the alternative revenue they can earn if they were to invest in Naira. Of course, it's very low. It's less than 5%. The yields on securities are less than 5%. The bank deposits are less than 5%. So what are they going to do to earn money that is going to be higher than interest rate and higher than inflation at 17%? So the answer to them is go and buy and import and export. And that's why you see a supercharge. I think the import of is going on is even higher. So we have higher trade imbalance right now, because we are now importing higher than the pre-COVID level. That tells you just how bad it is. And that frenzy has to be arrested somehow. But at the same time, you don't, you have to balance your approach on both the demand and the supply side to be able to extract value.
We thank you for your time on the show tonight, Professor Ken Ife, Development Economist at our Abuja Studios. Thank you so much. We'll see you next time.